Hello, everyone. It's Hard Money Jim here. Glad to be back. Hope you had a good week. Um, Let me, while I'm talking here, see if I can walk and chew gum at the same time. Let me call up my slideshow for today. And here we go. And Dylan, can you see me, or can you see my slideshow at this point?
We cannot see your slideshow yet. No, sir.
Okay. Well, don't know why that would be.
You might need to share your screen through Zoom.
That's what I need to do.
Yeah.
Correct. See what an amateur I am. Here we go. And
We can see it now.
yeah, let me just get to the bigger slideshow to get going here. Okay, how's that? Yeah, good. Thank you, Dylan, for that help. Okay, so I am broadcasting to you today from beautiful Coronado, California. I started to put a beach scene in the back because it's only a few hundred yards away, but I decided no, I didn't want everybody to get jealous. So here's my basic information. You can always find me by searching Hard Money Jim. Look for Substack Hard Money Jim to find my column. I announce anything I write on Twitter at Hard Money Jim and on LinkedIn. And I just wanted to let you know, I recently, just in the last week, had a essay published in Capitalism magazine. It's a pretty good source of good stuff on capitalism, and it's titled "Unmasking Inflation," talking about why the consumer price index is not a good measure of inflation, and the disingenuousness of the government authorities in using this as a measure of inflation. But today, the subject is excessive money creation, and the theme is that excessive money creation is typically caused by government. And when it's caused by government, it's a major cause of many of the economic problems that we experience today. And those things include unfair wealth distribution, which I want to talk about today, consumer price inflation being too high, surging house prices, the impossibility of saving, a false sense of prosperity among investors, supply chain disruptions, which we talked about last week. And the thing is that most people, even economists, make no connection whatsoever, or very little, between the quantity of money produced and major problems in the economy. And it's my point in writing Hard Money Jim is that money creation is not well understood. Most people have either no idea or a wrong idea of how money is created, how it comes into existence. And new money entering the economy has a very profound effect on both the creation and the distribution of wealth. And of course, creation and distribution of wealth is the central problem of economic science. So not understanding where money comes from and where it goes after it's created means that the effects of excess money creation are unknown to the vast majority of people. And when you don't know something as important as this, it causes you to make mistakes both in your understanding and your actions. And for example, if you don't know where money comes from, you will blame the unfair, unjust wealth inequality that we see today, and there's a lot of it. You'll blame that on Wall Street, or you'll blame it on capitalism. If you don't understand where money comes from, you will think, after years of quantitative easing, that it's easy to speculate in the stock market and win, that there's little or no downside. If you don't understand where money comes from, you'll blame consumer price inflation on the supply chain. I just heard Joe Biden do this the other day, and I hear many economists doing this. They're blaming price inflation on supply chain disruptions, when probably it's exactly the opposite. Probably supply chain disruptions are caused as much by inflation as they are by problems in the physical supply chain. But we're not going to talk about that today. If you don't understand where money comes from, you are likely to develop a false sense of prosperity in these kind of inflationary, speculative investment times we're in. You're possibly going to borrow too much. You're probably going to overspend. And so this period of unprecedented money creation, and here it is right here. You've seen this. This period right here that we're in, this last 2 years, provides a real teaching moment that I would like to take advantage of. It's like you can really understand water damage when you get a tsunami, and this is a tsunami. We have never seen this. If I took this money supply graph way back to 200 years, you would never ever see anything like this in the United States of America. And you would rarely see it in a third world country that has runaway inflation. This is a very unusual experiment in money creation. So it provides a teaching moment to see what increases in money supply can do. Just to make it concrete to you, I'd like you to imagine a 40% increase in anything. It's 39.5% increase. I calculated this a couple of days ago. A 40% increase in almost anything can be really profound in many things. Just to take an example, imagine that your healthy body weight was 150 pounds, and over a 2-year period, you added 40% to your body weight. So that means you would gain 60 pounds in 2 years and weigh 210 pounds. So how different would you look? How different would you act? How different would you eat and sleep? How different would you feel? That kind of a change over that short of a period of time would be very profound to your health. It couldn't possibly be healthy, but it'd be a very profound change in your health profile and would affect your physical and mental outlook. And the change and the impact of this kind of thing, in my mind, is equally profound to the economy. Now, I want to remind you, having said that all this money here, this new money, was created by the banking system. It was created in the banks. And it was created when the banks either made a loan or when they bought a bond. That's it. And the way I put it is, to put it into one unifying principle, money is created when a legally authorized bank purchases an asset. So when the banks, we've been over this before, and I'll repeat it. When the banks make a loan, what they're really doing is purchasing an IOU, purchasing a promissory note from the borrower. And they purchase it with funds they are legally authorized to create by creating credit out of thin air. Boom, ledger entry in the checking account, of the borrower create new money. Same thing happens when a bank buys any other asset like a bond, a mortgage-backed bond, a treasury bond. They simply pay for that bond from whoever the owner is by creating a ledger entry, a new checking deposit in that person's account. That's it. It's so simple. It almost defies imagination. Remember what John Kenneth Galbraith said, and I think during one of Seth's interviews, I put this quote up. It had a big effect on me because you hear this and you hear what I just told you, that banks make up money out of thin air in order to buy their assets or make their loans. You shake your head in disbelief. You don't believe it. Well, even back many years ago, almost 50 years ago, Galbraith, not a friend of capitalism, but someone who very well understood modern money creation, said the process by which banks create money is so simple that the mind is repelled. Is your mind repelled? Mine is. When something so important is involved, a deeper mystery seems only decent. Now, that's from a book called Money Once It Came Where It Went. By the way, that title sounds a little bit like the byline on my Substack. It's actually not where it came from. I actually came up with my byline, money, where it comes from, where it's going. I actually put something like that into a search engine, and I came up with this book, and I was very glad to find it because it's been helpful to me. All right, so some of this credit creation that banks do, I don't want to condemn it wholesale. Much of the credit creation that they do is for legitimate business investment. So, for example, if a bank creates new money in order to fund a very good business, there's new credit created and there's new wealth being created, and this is legitimate in my view. But since 2010, with the advent of quantitative easing, I would say likely a majority of the new money created, since there's been so much created. Go back, just look at it. It's been so much created that very likely, well, not likely, that most of that was not productive, in my view, not legitimate money creation. And so what I'd like to do over the next few sessions here, we'll start today, is to talk about the effects of excessive money creation. And by excessive money creation, I mean any credit creation that comes from a decision that to create credit that was either made by or influenced by illegitimate government activity. And by illegitimate government activity, I mean central planning, non-voluntary, non-free market motivated kinds of decisions. Okay. Now I've just listed here 8 or 9 effects of excess money creation that I've identified, that I know about, and that I either have written about or will shortly write about. And I have put these approximately in the same chronological order that I saw them since the beginning of quantitative easing back in 2010. And so what I'd like to do today is start with the top of the list there, unjust wealth distribution, and discuss that. And so the theme of this section of our discussion would be that unjust wealth distribution comes from the actions of the Federal Reserve primarily, but and it's a massive giveaway to the rich. It's been a massive giveaway to people who already own assets. But the subtext, the strong subtext is, don't blame capitalism. Okay. And so now let's get into that a little bit. Are we good so far, Dylan? I want to pause to be sure, since I don't see much. I want to be sure that we're okay.
Yes, sir. It's going well. I do want to thank Mary Elaine and Jean for their super chat contributions, but yeah, everything's running smooth.
All right, great. Thank you both, Marilyn and Jean, as well. I appreciate that. And Rozzy and Dylan appreciate it. So I want to go back to November 2010, when the economy was coming out of the Great Recession, or the Great Financial Crisis, whatever you want to call it. And the economy was recovering, but Ben Bernanke, then the head of the Fed, thought that he could make it do better. He was not content with the status quo. And so he came upon an idea that had been tried many years ago in Japan on a smaller scale than what he was about to do. And he thought it held promise. He decided that the Fed should buy in massive quantities, in large quantities, later became massive, US Treasury bonds, and later mortgage-backed securities. And this was such a radical change for what the US Federal Reserve normally did. This was a big change in policy. This has really never been done before, tried before. Though Bernanke had written about it and talked about it more than 10 years earlier in speeches that he gave to various meetings and convocations, which are interesting to read, but we won't go into that. But to explain this radical policy, Bernanke felt he had to write an op-ed in the Washington Post, and he wrote a famous op-ed, and it's probably one of the most widely downloaded pieces ever. You can easily find it, but I'm going to quote from it here. He said that by buying massive quantities of bonds, the Fed would affect the bond market. He knew this. And he said lower corporate bond rates will encourage investment, and higher stock prices will boost consumer wealth and help increase confidence, which can also spur spending. Now, right there, you can see he is a neo-Keynesian who thinks spending at the demand side is the source of wealth. But that's not his biggest problem. Increased spending, he said, will lead to higher incomes and profits that, in a virtuous circle, will further support economic expansion. Now, that's quite a claim. And but Bernanke was at least partly right about what went on. Here's what happened. You remember those corporate bonds that he talked about? Here's what happened to corporate bond rates. Right about where my mouse is when he announced quantitative easing. And the trend was sharply down, so that corporate bond rates, these are the rates at which corporations, good grade, not the best grade, but good grade corporate businessman risk kind of borrowing levels go for. And these rates went from about 5% right here down to 2.5% over a course of just a decade. So he was sure right about that. Now he was proposing QE, this bond buying, as temporary stimulus for a sluggish economy. And he said, in effect, that this was that this was trickle down type economics. This would be a tide that lifted all boats. But little did he know that it would lift, or maybe he did know, but I'm not sure he was aware that the effect would be to mainly raise the yachts of Wall Street while all the little boats were stranded in the harbor. So I want to take a minute here to explain what quantitative easing is. And I'm gonna keep it simple. And at some point, I'll write a detailed manual so that those of you who care can trace it in detail. First of all, remember that money is created by the banks, not by the Fed. So if you let's just imagine that you have a treasury bond. You're an investor, you own a treasury bond. And Ben Bernanke comes along with quantitative easing. He says to the banks, hey, banks, I will buy treasury bonds from you. The banks say, hey, I can purchase treasury bonds from investors and resell them to the Fed immediately. Like in one transaction. So you, the bond seller, sell your bond to the bank. You get new money for that bond, where before you had a bond, now you have money. The bank now has the bond, immediately sells it to the US Federal Reserve. The Fed gives that bank a small profit on the bond. Plus, however long the bank holds the bond, they earn interest. So the bank likes this business. They can just turn bonds from, investors over to the Fed, and they gain new reserves and a profit. You, the investor, are the holder of the new money, and you, the investor, are yield hungry. So you're going to go out and look for a replacement for what you just sold. However, the Fed in buying bonds has boosted the price of in the bond market and raised interest rates. I'm sorry, that's incorrect. They've raised prices of bonds and lowered interest rates. You now are forced to go out and look for something either that is of longer maturity or of lower quality to replace your interest rate. And if you can imagine this process iterating time after time with hundreds of billions of dollars over years, you gradually move the market such that asset prices go up, interest rates go down. You, as the Fed, are setting a floor on prices of bonds. You are removing risk, at least the perceived risk, from the bond market. You are encouraging people to speculate on the upside more and more. And you set in motion a chain of events which you, the Fed, are supporting that raises asset prices and lowers interest rates. Now, I know that's quick, but that's the basic mechanics. So here we are in QE that went on for, and still going on. And one big effect was to lower interest rates drastically, as you see here. But here's the even bigger effect. And this chart needs a little explanation. It's not that complicated. All right. Right here where my mouse is right about where QE started. The black line shows the standard, and this is on the left scale, the level of the Standard & Poor's 500, major, probably the broadest indicator of blue chip stocks, of high quality stocks, okay? And you can see it has been steadily and almost exclusively up for the last 12 years. The right-hand scale, which is the red-orange line, shows the Fed's assets on their balance sheet. Now, why are the Fed's assets important? Because the Fed's assets consist of the bonds that they buy. And so as they engage in QE, the size of their balance sheet goes up and up and up, the size of their assets. And you can see their assets went from about less than $1 trillion, $800 billion before the great financial crash. And then they did an initial stimulus, right during the crash or right after the crash. And right here is where they started QE, where my mouse is. But you can see since then, they have added and added and added. They had QE, QE2, QE3. Somewhere in here, they did something called Operation, I guess probably right here, they did Operation Twist, where they didn't really add assets, but they lengthened the maturity, which caused interest rates to come down even more. And during periods like this, around 2018-19, when they started to let the balance sheet run off, the stock market crashed and then crashed again. The Fed had to step in. And right here, of course, is the beginning of the pandemic and stimulus. No holds barred. I'm going to keep coming back to it. Sorry. Remember that? Don't forget that. That is the big stimulus that did this big run up, this 200% run up, and this 280% run up since QE started, and this big increase right here. So now Bernanke knew this. Bernanke knew this was happening. Look at his statement, and you can see he knows who owns the assets. He knows that rich people own the assets. And so he knew who was going to benefit. There's no question in my mind about that. There should be no question in anyone's mind. And this was a big boon to Wall Street. And I'd like to now spend just a few minutes on Wall Street and talk about Wall Street's reaction and why they don't bear the major risk for the major responsibility for this. How are we doing on time, Dylan? Can I have about 7 more minutes?
Absolutely.
Okay, good. So, whatever he thought about the prospects of consumers, the prospects of Main Street and so forth, Bernanke was well aware that he was throwing a big, big fish to Wall Street when he started QE. And without a doubt, that aspect of his policy was intentional. And then in the early days of QE, 2010, 11, 12, 13, I will tell you frankly, I wasn't sure what was going on. I was actively involved, in the markets then. But I'll tell you when I caught a clue. And that was in 2015. This is when I began to really seriously understand what was happening. The Wall Street mavens were very quiet about this, even though the smartest ones knew what was happening. Okay, because they are getting access to the cheap money. They're getting access to the cheap borrowing. They're turning their treasuries over for a profit when they sell them to the banks who sell them to the Fed. Okay. A very smart investor, one of the smartest I've heard of, named Jonathan Tepper, runs an outfit called Appaloosa Management, did an interview for Bloomberg News. And he said, I'll quote him here, he said, "It's kind of hard to fight money." He said, "Don't fight the Fed. Now you've got 4 Feds. Don't fight 4 Feds." What he was talking about was the fact that just recently, just before he made the statement, the Bank of Japan, the Bank of England, the Swiss National Bank, the Bank of England, the European Central Bank, all the world's major central banks had emulated the Fed and engaged in their own quantitative easing asset buying programs. Okay. After just 3 years of QE, Jonathan Tepper's annual personal income in 2014, personal income was $3.5 billion. So I don't know what it was, if it was guilt or if he said, gee, I've earned all I need to know. No, he kind of came public and let the cat out of the bag. This is what I saw happening. I thought, why would he talk about this? So clearly something was driving him to do that. But after that, it became very clear in my mind, and you heard more and more people talking about this game and this enhancement of Wall Street wealth that was going on. Now, today, even after this massive bond buying program for 12 years, this is still the Fed's one trick pony. This is what they do. They buy, at this point, 120 billion per month in treasuries, expanding the balance sheet. However, they said they're going to stop and start tapering next year and raise interest rates. We'll see if they do. That's a whole new story. But anyway, my big point is Bernanke understood the game, what he was doing. So did the successors, Janet Yellen and Powell. And they would never take responsibility for the disparity of wealth that was occurring between Wall Street and Main Street. And so even as recently as less than a year ago, Jay Powell was denying that quantitative easing had anything to do with wealth inequality, which is everyone knows is disingenuous. So, who's to blame for this? This is what I want to finish up with. Who's to blame for this unjust wealth distribution that we've seen? There's no question that a lot of it has been. Not all. It's hard to separate what is and what isn't. But who's to blame? It's tempting to blame Wall Street's good fortune on Wall Street. It's tempting to resent them, let's say. But if we're going to be objective, we have to distinguish between those who produce their wealth and those who get it by forced redistribution. So I like to call it the Steve Jobs kind of wealth versus the David Tepper kind of wealth. And by the way, I'm not condemning David Tepper, as I'll tell you in a minute. Because almost everyone respects the Steve Jobs kind of wealth. For a price of an iPhone, Apple's customers get really remarkable value. And if wealth, so-called wealth, consists of valuable goods and services and means of production, I think that's what it is, then the wealth that Steve Jobs created for his customers dwarfs the massive profits that he earned for himself. I mean, his profits, what he earned for himself is huge, but the value that he provided to others is many times that. And so even an altruist respects the Steve Jobs kind of wealth. For the price of an iPhone, Apple's customers get remarkable value. But, just as most people respect the Jobs wealth, they despise Tepper's wealth. And those kind of opposing views might seem reasonable at first glance because the differences between Jobs' fortunes and Tepper's fortunes could not be more stark. Jobs won his wealth in a competitive marketplace with technological innovation. Tepper, though he's very smart, got a windfall that came from government policy that was intentionally designed to reward those who already owned financial assets. But it was the US Federal Reserve and not Wall Street that caused that very skewed economic outcome. So Wall Street grew fat. This is the way I like to put it. Wall Street got fat. But they got fat in the same way as a barnyard goose that you're stuffing for foie gras got fat. They got force-fed, and they didn't really ask for it. They also didn't complain. Very few complain. I can name a few exceptions who have called this out for years. James Grant is one, Grant's Interest Rate Observer. Bill Fleckenstein's another. Grant Williams is another. There are a few, quote, good guys who get it and who warn against it. Much of Wall Street is content to just be force-fed. So I'm sad about this. Financial markets, I've been around financial markets many years, and they were not always rigged like this just to benefit the rich. The Wall Street I grew up in was a place that demanded analysis, price discovery, and really competitive trading. And those were, in my view, some better times, and I hope they come back, and I think they might. But until QE came along, it was the market and not the government that chose winners and losers. Now, many of the winners have been chosen, as we've seen, been chosen by money pumping, quantitative easing. So don't blame Wall Street for the injustice that has been sort of wrought by quantitative easing. And I hope you can use this as intellectual ammunition to take it to your friends if it's useful to you. Blame the Fed, or better yet, blame Congress, which can always change the laws that govern the Fed, or blame the Parliament, which can always change the laws that govern the Bank of England, or wherever you get it, wherever your respective legislature is. Now, there's another related error that's made, and some people will blame this unfair wealth transfer on capitalism itself. They won't blame Wall Street. They'll say, well, it's not David Tepper's problem. It's the whole system. It's the capitalistic system, in which they presumably include the central banks run by governments and quantitative easing. But that's really wrong, because I will tell you, authentic capitalism is nowhere to be found at the central banks, nowhere. Remember that capitalism's essential trait is private, that is non-government ownership of the means of production. So under genuine, real capitalism, as we understand it, all economic relationships, including financial transactions, all the bond buying, selling, and so forth, all those are voluntary under real capitalism. And any kind of force or fraud, whether it's initiated by citizens, other citizens, or by the government, is illegitimate and is, under real capitalism, illegal. And, under real capitalism, the whole reason government exists is to protect life and property. And we as citizens grant our government a monopoly on the use of force. You all know this, standard, Ayn Rand philosophy, Ayn Rand teaching. Government uses this delegation of the monopoly on the use of force only when necessary to protect us against force and fraud. And the principles of capitalism require that no one, and not even the government, can disrupt voluntary trade between consenting parties. So Steve Jobs' kind of wealth, that wealth that we respect, that came from capitalism, or what remains of it. And by contrast, the Fed's very perverse transfer of wealth to the rich came from the opposite of capitalism. And that's government central planning imposed on financial markets by force. And it is in the specific form today of the Fed's policy of quantitative easing. So to sum up here, I want to put this in objectivist terms. Quantitative easing is just a species of despotic behavior. It favors the wealthy, and it penalizes almost everyone else. When the central bank picks out economic winners and losers, it's abandoned capitalism, and it's crossed a new frontier that I call, and have called in other things I've written, monetary fascism. It's manipulation of the government by force through monetary channels, manipulation of the economy by force through monetary channels. And so it's high time that we held Congress and our legislators accountable for these kind of economic justices. I suspect that they won't become accountable again, or won't become more accountable until we have a real problem, that a real economic problem, a real prosperity problem that wakes people up. Okay, and on that happy note, since I think I've probably overrun my time a little bit, I will stop. And if there's any questions or discussion that we can get in, I'll be glad to talk about that now.
So today we just got a couple super chats without comments attached, but we did get super chats from Marilyn and James. Thank you guys. But yeah.
Okay. Well, thank you so much. We will resume with some of these other effects of excessive money creation next time. And if you want to subscribe to me on Substack and use that as a way to answer questions, ask questions, to contribute to these podcasts, that would be great with me. So, all right, we good?
Very good. Thank you, sir.
All right. See you next week, everybody. Thanks.